Upbeat, rhythmic intro music fades.
All right, let's jump right in. The market is flashing some seriously mixed signals today. We need to nail down exactly what this new regime is.
The big story is this tug of war. We are absolutely in a risk-on expansion, but it's slamming right into a wall of inflation tension. Host 3, from the risk asset side, what are you seeing? Oh, it is a full-on green light. Equities, crypto, the expansion is the real deal. The problem is, it's getting challenged on day one by a huge breakout in energy. That's where all the friction is coming from. And you see that friction pop up immediately in the bond market. This inflation impulse is forcing yields to wake up, and that just complicates what should be a really easy rally for risk assets. Exactly. It's an expansion that's hitting a major speed bump right out of the gate. Let's run the numbers.
Okay, let's hit the dashboard. I want a quick fire round here. What are the key moves telling you both?
Well, starting with the big one, equities. The S&P is making a really convincing charge at 7,200. This is not some tentative little move, it's a loud and clear signal that the expansionary regime is back.
Right, but here's the immediate counterpunch for the market. Oil just blew past $91. And look, this isn't just another commodity move, this is inflation knocking on the door again, loud and clear.
And the risk appetite isn't just in stocks. Host 3, look at Bitcoin.
No way! It's blasting through to 78,000? I mean, if you just look at pure risk appetite, that signal is absolutely undeniable.
And check out the VIX, it's down at 18. This is the classic tell, right? When volatility gets crushed as prices are ripping higher, that's usually just pure rocket fuel for a rally.
And the bond market is doing exactly what you'd expect it to do. The 10-year yield is grinding up to 4.30%, but, and this is key, it's doing it in a very controlled way. It's pricing in that inflation pressure without totally freaking out the market, yet. So, long story short, from a risk perspective, it's green lights all the way down.
But the bond and commodity markets are screaming yellow on inflation. And the dollar index? It's just stuck in the middle, totally unchanged, trying to figure out which way to go.
And that right there is the key takeaway from the dashboard. This is not your simple, clean rally. It's an inflation-led expansion, and that changes the entire game.
Okay, we have to zoom in on oil, because honestly, this is the single most important chart on anyone's screen today. We just saw a definitive, powerful breakout from that tight $88 to $90 range.
You know, crossing $90 isn't just a number, it's a complete narrative shifter. It forces the inflation story right back to the top of every single macro conversation. It just makes this rally messier.
And you know it's specifically about inflation because gold is actually a little weak today. So this isn't some flight to safety, uh-oh moment. It's a direct targeted bid for energy.
That's the perfect synthesis. Oil has officially grabbed the steering wheel of the macro story again, and it's injecting a dose of inflation right into the heart of what was a clean risk-on expansion.
So this slide really lays it out, the two big forces going head-to-head. Host 3, that column on the left, that looks like a perfect setup. It's absolutely textbook. S&P up, Bitcoin ripping, VIX getting crushed. If you saw that in a vacuum, you'd be hitting the buy button with both hands. But you can't ignore the right side. That's the pushback. Oil is the main culprit, and it's dragging the 10-year yield right up with it. That's the friction. That's the problem. And that is the entire story for today. A clean, beautiful expansion running smack into a dirty, inconvenient inflation problem.
Okay, so how does this oil shock actually travel through the rest of the market? Let's trace the chain of events step by step.
So step 1 is the catalyst. Oil breaks out. That one event is what forces the entire market to sit up and reprice inflation across the board.
Right, and that immediately kicks off steps 2 and 3. Inflation expectations jump and yields have no choice but to follow. And that directly raises the cost of capital for everything. Stocks, crypto, you name it.
Which brings us to step 4. That's where we are right now. Risk assets are, for the moment, absorbing this hit. They're still climbing, but they're now fighting a brand new headwind that literally wasn't there 24 hours ago. The entire environment is fundamentally different.
Okay, so given this tension, this new dynamic, let's game out the next 24 to 72 hours. What are the potential paths from here?
Okay, so I'll take our base case, what we're calling inflation-accepted risk on. Basically, the market just deals with it. Oil stays contained in this new $90 to $92 range, and equities just keep grinding higher, maybe towards $72.50. Now, the really clean bullish case, that needs this inflation pressure to back off. If oil somehow drops back below 90, yields would probably ease up, and you'd see the high beta stuff like Bitcoin just explode past $80,000. And on the flip side, the bearish scenario is just more of the same, but intensified. If oil pushes past 92 and drags yields up over 4.35%, you're going to see the VIX spike, and this equity rally is going to hit a brick wall, hard.
That's it.
The path forward is all about how the market decides to process this next leg in energy prices.
All right, let's bring it all home. What is the final, crucial synthesis of today's market action?
Look, the risk-on rally is not up for debate. The price action we're seeing in the S&P, in crypto, it's conclusive. It's happening.
And the reheating inflation is just as undeniable. The signal coming from the energy market, from the bond market, it's crystal clear. Both things are true at the same time.
So can the rally survive? The answer is yes, it can. But what you're watching is the textbook definition of a late cycle expansion. It's growth, but with an inflationary tax attached to it. And this is so important. We're in a flow window right now. There's no major data coming out, so the market isn't trading on headlines, it's trading on pure positioning and flows, which makes the price action that much cleaner, that much more real. And in that kind of environment, something like crypto becomes an even better leading indicator for risk appetite. But, and it's a big but, it's now hypersensitive to every little tick in oil and yields.
And that brings us to our final thought. Stop looking for a headline to explain the next move. In a flow-driven regime like this one, it's the underlying market structure, and only the structure, that sets the direction.